As we move further into 2026, the global economy is entering a critical phase marked by both opportunities and challenges. On the one hand, the International Monetary Fund now expects global growth to remain above 3% in 2026, highlighting a degree of resilience. On the other hand, geopolitical tensions and trade policies uncertainties continue to pose structural risks and reshape investor expectations. From an asset allocation perspective, the outlook for the US dollar, precious metals such as gold and silver, and investment opportunities in China and emerging markets are increasingly in focus. Against this backdrop, we are delighted to be joined by Mr. Steve Bryce, Global Chief Investment Officer for Wealth Management at Standard Chartered Bank, to share his insight on the global outlook and investment strategy. Welcome, Steve.
Okay, perfect.
To start with the big picture, how do you see global economic growth shaping up in 2026?
The way we sort of think about 2026 is it's more of a muddle through economy. So it's not, growth is unlikely to be really, really strong pretty much anywhere in the world. There are pockets, of course, but if we look at the main drivers, whether we're looking at the US, China, or Europe, I think growth is going to be reasonable, but it's not going to be too stellar. So if we look at the US economy, obviously, we are seeing signs that the labor market is weakening there, which is leading to projections for slightly slower growth, I think, in 2026 versus 2025. But obviously, we've still got the CapEx cycle in the tech sector and AI supporting growth there. So overall, that leads us to an environment that is, as I say, it's a low probability of recession, but it's but sort of 60% of this sort of muddle through slow growth environment.
Markets have been grappling with the trade tensions and geopolitical risks. Do you think these risks are already fully priced in, or are some still being underestimated?
I think I'd separate the geopolitical and trade. So on the trade side, I mean, obviously we've got some news over the weekend that means that maybe we're still going to get some trade news coming in. But I think the rest of the world is learning how to deal with the threats coming out of the US. So from that perspective, I think the trade will become less of an issue as we go through 2026. Obviously, on the geopolitical side, so obviously what happened in Venezuela is something that people are very focused on, what's going to happen with Greenland. So I think those issues are going to be recurring themes as we go through 2026, as the US heads towards obviously the midterm elections. And tries to sort of come around several issues to try and gain votes as we go into those elections. So I think that's something that we need to be aware of. It's really difficult for markets to price these things because it's not something that you can put into dividend cash models or anything like that. Usually these have a short-term impact on markets, but it's very difficult to actually identify when they will hit and how severe they will be.
So against that backdrop, which countries or regions do you see as the main engines of global growth going forward?
If you look at the major economies, just from a headline growth perspective, obviously the countries such as India and China will be outpacing developed market economies by a significant margin. So India obviously growing very fast, in the sort of 6.5–7% range. China probably just under 5%, but still pretty healthy growth. So they'll continue to be the key drivers. US probably kicking around the low 2%, so still okay, but not fantastic. And Europe obviously struggling even more than that, although obviously we're seeing a big increase in industrialization and obviously defense spending. So that should lead to a floor under European growth, but struggling to get above the 1–1.5% growth rates in Europe as a whole.
Let's turn to China for a moment. Do you expect China to maintain relatively solid growth in 2026?
We saw growth in last year was pretty front loaded. So we saw the stimulus coming through and having a very strong impact on growth in the first half, and then waned a little bit in the second half. But I think on the positive side, I think this is really important, is that we saw inflation bottom out. If that's sustained, I think that's really, really positive for the Chinese economy, because the thing that the economy really needs is nominal GDP growth, not just real GDP growth. So if you can get 1% inflation added to a 4.5-5% real growth, and obviously that really helps manage debt challenges and encourages increased investment and spending across the economy. So for me, inflation still remains one of the key things to watch, but it has bottomed and likely to head towards 1-2%. That's a really massive positive for the economy.
So what do you see as the key drivers or policy supports behind that resilience?
Obviously, we've already seen some monetary policy easing coming through. So from that perspective, I think it's going to be more of the same, just trying to make sure that the economic activity holds up. I think the key challenge that the authorities are very, very aware of is those debt levels. So they don't want to be doing things that lead to excessive debt build up into the future, because they know that will just cause challenges down the road. So it's really a balancing act of trying to make sure that the economy does reasonably well, but it doesn't become over indebted. So monetary policy is one lever that they're obviously pulling, but the other one is obviously on the fiscal side as well. The area that we really need to try and focus on is on trying to stimulate consumer spending. And I think anything that we can do to see the property market stabilize and improve, I think that would be a big positive for consumer sentiment and be another bow to the authorities' growth target.
From an investment perspective, which sectors or themes in China look most attractive in 2026? And would you consider overweighting Chinese assets?
Yeah, we are overweight Chinese equities. If we look at our global views and then come down to China, so we're overweight global equities. We like Asia ex Japan equities within that, and then within that we're overweight China. So we see tech as a major driver actually globally, not just in China, but we're overweight technology in the US, Europe, and as well as China. Obviously, this is a major investment theme, I think, for investors today, but also something that is supported by policies. People realize the importance of technology and AI, not just from an economic growth perspective and an earnings perspective, but obviously also from a geopolitical perspective as well. So it's really important not to fall behind and ideally to be the leader in that space. So from that perspective, we see a lot of investment being put into it. AI, CapEx spending, certainly in the US, in the hyperscalers, is expected to grow around 40%. I don't have the numbers for China, but I would imagine it's a significant jump as well going into 2026. So yeah, technology remains a key theme for us across all of the markets, including China.
But do you worry that global markets may be getting too dependent on the AI narrative?
I'm not worried yet. I think we'll probably get there. So I think one of the questions that we were asked, obviously, as we go into this year, and in fact, our 2026 outlook was entitled Blowing Bubbles. So the question is it a bubble or not in tech and AI? And our view is that it's not. Two reasons for that. So globally, we're still quite early in the build out of AI. So if we look at the investment as a percentage of GDP in this space, it's a lot lower than it was for the dot-com boom of the late 1990s. And secondly, if we look at that, and this is more of a US argument than necessarily global, obviously very important, is if you look at the relative performance of the US tech sector in 1999, we saw the tech sector massively outperform in the late 1990s, of course, but that wasn't associated with a massive outperformance in terms of earnings growth for the tech sector. So that gap that developed there was effectively the bubble that we came to know and was burst in early 2000. Whereas if we fast forward to today, there's no such sign of any gap. Tech earnings are growing much faster than earnings as a whole, and that's supporting the fact sector is outperforming from a price perspective as well. So from our perspective, those two factors mean that we think this AI boom can continue. So the way the sort of timelines or the comparisons I'm trying to draw is saying that this feels more like 1997 than 1999 to me, which means we still feel that we have some way to go.
Looking beyond China, how do you assess the opportunities and risks in emerging markets equities in 2026?
Within emerging markets, there's two areas that we're overweight. So China is one, but the other one is India. And now India significantly underperformed in 2025. We had a neutral allocation to India last year, so underperformed by about 33%, obviously, which is a significant underperformance. And lots of things going into that. Obviously, valuations were quite elevated. And we also saw people downgrading their earnings estimates through the year. But I think what we're seeing now is we're seeing increased tailwinds. So valuations are obviously less stretched. They're still not cheap compared to China, for instance. But the structural growth story is very strong. We're starting to see people upgrading their earnings expectations for India. We've seen policy reform coming through in terms of VAT, GST reforms within the country. And we're starting to see some signs that international investors are adding to their Indian holdings, which I think would be a positive as well. So from that perspective, India is the second overweight we have within the emerging markets alongside China.
Now on currencies, do you expect the US dollar to stay relatively weak this year?
So we believe in a slightly weaker dollar in 2026. It's not like we saw in the first half of last year where we saw quite an aggressive sell-off in the dollar, but it obviously is slightly softer. And I think that's a positive thing for investors generally, actually. If we see asset classes generally do better when the dollar is weaker, whether you're looking at bonds, whether you're looking at equities, or indeed commodities. So the fact that we've got a slightly softer dollar is a good environment for investors. It does have obviously even more positive for emerging markets relative to developed markets. So from our perspective, it's one of the reasons why we're overweight Asia ex-Japan equities, but it's also why we prefer emerging market bonds to developed market bonds. So whether that's actually US dollar government bonds or even local currency government bonds, if we've got a weaker dollar, both should be supported by that, slightly lower treasury bond yields as well.
And what about gold? Do you still see room for investors to increase exposure at this stage?
And actually, it's quite normal for gold to do very well at the beginning of the year. So I think this is the fourth year out of 6 where we've seen very strong gains in the first month or two. I think that's probably because central banks, emerging market central banks in particular, are looking to add and increase their reserve holdings in gold. And this comes down to what happened to the Russian central bank in terms of sanctioning it in response to the invasion into Ukraine. Yeah, I think a lot of central banks saying, how much should I be having in US treasuries or in even European government bonds at the risk of they could be frozen in an extreme circumstance, so people diversifying into gold. We'd certainly say the gold uptrend looks likely to continue on a multi-year basis. So certainly if we did see any dips, then that would be a buying opportunity. But from a portfolio construction perspective, we have around a 6% allocation to gold, which is quite high. It's higher than most people have. Most people are around the 2 to 3% area. But that's certainly been helping us from a portfolio management perspective. It's obviously boosted performance. Gold was up over 60% last year. So obviously that was very helpful when we had such a high allocation. And we retained that for 2026 as well.
Finally, what asset allocation advice would you give to investors right now, and which key risks should they be most mindful of in 2026?
Yeah, it's a really good question, right? I think maybe we'll start with the second question first, because I think the key risk obviously we talked about geopolitics and trade, but the key risk for us is what happens if inflation in the US doesn't come down actually probably more importantly goes through 3%. That would be really challenging. But the moment we see the balance of being the Fed can cut rates, we're looking for 75 basis points of cuts this year. That's based on weakness in the labor market and stable to maybe moderately lower inflation. But obviously if inflation was to surge significantly, that would be much more challenging for the Fed to justify further rate cuts. And that could lead to volatility in bond and equity market. So the key for us is always diversify as much as you can. And that's so within equities, so whether it's looking at between regions, so we mentioned the US and Asia, but also from a sector perspective. So for instance, in the US, we're overweight healthcare and utilities as well as tech to try and balance off that to get some form of diversification coming through. We talked about gold as well, but then where available, if people have access to private assets or hedge fund strategies, those are useful diversifiers as well from our perspective because they have a different volatility, different correlation with equity markets. So if you add those, you generally pick up your expected returns quite significantly, a very limited increase in risk. So to the extent possible, people should diversify as many sources of return as possible. That's always the case, but feels particularly important as we head into 2026.
Thank you, Steve, for sharing your insights with us.
Okay.
That's all for today's show. Thank you for watching. See you.